Hello, my name is Becky, and my research project for Accounting 202 is on the Cato Corporation, a retail women's clothing line. Cato's was incorporated in 1846 by Wayland Cato. Cato's Corporation's headquarters are located in Charlotte, North Carolina. They have over 1,300 stores located in over 30 states in the Southeast and are planning on expanding its stores into the Northeast and the Midwest. Cato also operates under the name Cato's Plus, Persona, It's Fashion, and It's Fashion Metro. Cato's market is geared towards the southern low to middle income customers. Their market is mostly for women aged 18 to 50, but they also have a men's, children, and a newborns clothing line. Cato's has two segments, their retail line and a credit layaway program. This slide is to show Cato's current ratio. The current ratio is a ratio that measures liquidity. It allows companies to measure their short-term debt paying ability. Cato's current ratio is 2.45, and as you can see, they are above industry standard in the ideal range for this ratio. This slide is about the acid test ratio, which is also a liquidity ratio, and it measures the dollar amount of liquid assets available for each dollar of current liabilities. The ideal ratio for the acid test ratio is 1 or greater, and as you can see, Cato's is 1.65, so it's above the 1.0, so they're doing good there, and it is also above the industry standard. This is Cato's inventory turnover ratio, and it is a liquidity ratio that measures the liquidity of the inventory. The higher this ratio, it means the more inventory that's being turned over in a year. And Cato's is 4.42, which is below the industry standard of 6.27. It's not a bad inventory turnover ratio, but they're not meeting up to the industry standard. A low inventory turnover ratio could be a sign of inefficiency, and it may imply that they're either having some poor sales or that they have an excess of inventory. This is Cato's accounts receivable turnover ratio. It's an activity ratio, and it measures the number of times per year that a business collects its average accounts receivable. Cato's accounts receivable turnover ratio is 9.43, which is a little bit below the industry standard ratio of 14.82. The higher ratio, the better. It measures how effective a company is in extending its credit and collecting the debts on that credit. In some ways, the accounts receivable turnover ratio can be looked at also as a liquidity ratio as well, because companies are more liquid the faster that they can convert their receivables to cash. This is Cato's asset turnover ratio. It's an activity ratio, and it measures how effectively assets are used to generate sales. Cato's asset turnover ratio is 1.60, and that's below the industry standard ratio of 2.47. This ratio shows that for every dollar invested in assets, the company is gaining the ratio amount in sales. The asset turnover ratio also gives investors and creditors an idea of how a company is managing and using its assets to produce products and sales. This is Cato's return on assets ratio. It's a profitability ratio. It measures the efficiency of a company in using its assets to generate net income. Cato's return on assets ratio is 10.69, which is considerably higher than the industry standard ratio of 4.22. So the higher the ratio, the better. From an investor's point of view, the return on asset figure gives the investor an idea of how effectively the company is converting the money that has been invested into net income. This is Cato's return on common stock equity ratio, and it measures the amount of profit a company earns per investment dollar. Cato's return on stock equity ratio is 8.88, and the industry average is 12.83, so they're a little bit behind in this ratio. The higher the ratio, the more profits being earned. This ratio measures the success of a company in generating income for the benefit of the common stockholders. This is Cato's earnings per share ratio, and this ratio helps determine the portion of a company's profit allocated to each outstanding share of common stock. Cato's earnings per share is 2.39, which is just a little bit lower than the industry standard of 2.82. Earnings per share is an indicator of a company's profitability growth in the future. Earnings can cause stock prices to rise, and when they do, investors make more money. If a company has high earnings per share, it means that it has more money available to either reinvest or distribute to its stockholders in the form of dividends. This is Cato's price-earnings share ratio. It is used for valuing a company. It measures the current share price relative to its per share earnings. The price-earnings share ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company's earnings. Cato's price-earnings share ratio is 8.93, which is a good bit below the industry standard of 20.28. A price per share earning ratio suggests that investors are expecting higher earnings growth in the future. This is Cato's debt to asset ratio, and it measures the percentage of total assets provided by creditors. Cato's debt to asset ratio is 0.36, and the industry standard is 0.66. And this is great because this is one ratio that the lower the better. The debt to assets ratio defines the total amount of debt relative to assets. The higher the ratio, the higher the degree of leverage, meaning the higher the ratio, the higher the financial risk. So a ratio greater than 1 shows that a considerable amount of assets are being funded by debt. This is Cato's book value per share, and the book value per share ratio is figured by dividing the common stockholders' equity by the number of average shares outstanding. As you can see, Cato's book value per share is 15.06, which is above the industry standard of 5.07. If book value is less than market value, stock may be more appealing to the investors. Investors use this ratio to determine if a stock is undervalued. If a business can increase its book value per share, then investors may view this stock as more valuable, and that will cause the stock price to go up.